On today's episode, we're going to take a look at two companies and put them against each other. Today, we're going to do Baba versus JD. So let's get started. Like I said, guys, today's episode, we're going to take a look at two companies and put them against each other. We're going to take a look at Baba versus JD. But for me to actually give some form of see which one I like better, I have to have some form of baseline. So I've created the following rules or the following sectors that I'm going to take a look at for each company and give a point to that company if I think it's better. Remember, at the end of the day, I am nowhere near a professional. So these are just my opinions. And one thing though, just because one of them is going to be a winner does not mean that the other is a bad investment. Both of these could actually be a good investments. I'm just going to take a look at the information we have at hand and go from there. So some of the things we're going to take a look at is market cap growth, revenue breakdown, margins, the overall business, the balance sheet, the operating cash flow versus revenue, operating cash flow versus earnings per share, forward PE ratio, forward price to sales ratio, my thoughts, and then we'll just total the points. And before we go any further, guys, don't forget to hit that subscribe button, the thumbs up, and the bell. It helps the small channel out so much, and I truly appreciate the support. I'm very active here on YouTube, but you can also find me on Twitter, and I do have my Discord channel where you can come in and just ask any questions. Finally, let me know on the comments what you guys want me to do next, either Alibaba versus Amazon or JD versus Amazon. The one with the most comments is obviously the one I will do next. The first thing I want to talk about is just the overall companies. Before we take a look at any of the points, let's just take a look at each of the companies. So first, let's start off with Alibaba. Alibaba, what they pretty much do is they're pretty much both of these are companies in China, and both of these companies have taken a huge impact due to the whole Senate bill. Both of these companies mainly deal with e-commerce, but the type of company of customers they deal with is different, and they also have a little bit subsection regions that we are going to take a look at throughout this episode. But like I said, both of them pretty much are in the e-commerce business. Alibaba mainly deals with business to business type revenue, where they more deal with different companies, while JD is a bit different, where it deals with business to consumer. And business to consumers usually have lower margins, and that's one thing we are going to take a look at. So again, this is something just to keep in mind of when we take a look at further into the episodes, that even though they kind of in the similar markets to some extent, they do deal with different customers, so you will see some discrepancy between some of the items here. All right, guys, so the first thing we want to take a look at is market cap. And when I'm going to take a look at market cap, not only am I taking a look at which one is bigger, that's not the one I really care about. It's more how much is growing, right? If it's growing throughout the past years, because if it's growing throughout the past years, that means the stock price for this company has returned positive investments to the shareholders. Both of these companies are pretty new, and the first thing we can obviously is Baba is a way bigger company than JD. It is where Baba is worth somewhere around 469 billion. JD is worth around 51 billion. So we can see the market cap for these are tremendously different between the two. Baba is about 8 times larger than JD. But like I said, right, I don't really care much about the market cap. I want to see more about that growth. In 2015, Baba started off at 205 billion. Right now, it's sitting at about 469 billion. So in a matter of 5 years, this company has produced about, I would say, 100% return to an investor, right? If you bought in 2015, your gains are over 100%, and I'm pretty sure that's way better than the market. And one thing we are going to take a look at is we're going to take a look here at yearly data, and we're going to be taking a look at historical data, at historical points, because as a long-term investment, and that's what I am a long-term investor, I don't really care what kind of happens quarter to quarter. That to me is noise. What you really want to see is the overview change of that business throughout years, because businesses take years to grow, not quarters. So we're going to be taking a look at them throughout the years for this. Next, let's take a look at JD. And JD's market cap started off at 45 billion in 2015, and right now is sitting at about 51 billion at the end of 2019. So if you are an investor in JD, you are probably kicking yourself in 2015, because the market has returned better results than JD at the moment. So that's obviously the first point here we're gonna have to give to BABA, just because we see that huge growth for it. Next, let's take a look at this company's revenue growth. So when we're taking a look at revenue growth, it's exactly what it sounds like. We're gonna see at how in the past 3 years, how this company's revenue has been growing. So let's take a look at BABA. BABA in 2017 compared to 16, it grew 54% its revenue. In 2018 compared to 2017, it grew another 58%. In 2019 compared to 2018, this company grew another 50%. So we can see Alibaba is growing at a heavy rate, right? A double-digit growth, even in the high 50s to low 50s. It is pretty impressive to see that for a company. So now let's take a look at JD. Has JD seen the same results? It is one thing we can see. JD is growing at a fast rate, but probably not at a fast rate as BABA. So JD in 2017 compared to 2016 grew 40%. In 2018 compared to 17, it only grew 27%. And the 27% growth is amazing, right? You don't see many companies growing at this rate. So that at the end of the day is still pretty amazing. And then in 2019, it grew 24.8%. So again, double-digit growth, but nowhere near that growth that BABA is seeing. Again, 24% is not something to just say it sucks, right? JD does not suck just by seeing this. It is growing at a heavy rate, but unfortunately, BABA is growing at a faster rate. So the second point here has to go to BABA. So it seems like Alibaba is taking the lead right now. All right, so now the next thing we're going to take a look at is these companies' margins, and we're going to take a look at gross profit margins. We're going to take a look at gross margins and at profit margins, and then we're going to see which one is growing, if any are seeing any type of growth, and give a point based on there. And one thing I have to note right now, especially, I did mention it earlier, but at the end of the day, BABA's gross margins should be a lot better than JD's gross margins. And the reason is pretty simple. Gross margins for BABA deal with a business-to-business transaction, which usually provide better margins than when it is business to customers. Business to customers usually provide in the simple digits of margins. So that to me is something I do expect to see, but profit margins should not really determine. This pretty much shows the strength of the company. So let's take a look at Alibaba's gross margins and profit margins for the past 3 years. In 2017, gross margins were 62.4%. In 2018, it was 57.2%. And in 2019, it was 45.1%. One thing that we are seeing is that gross margin is decreasing. And that's definitely not something you would want to see. And now let's take a look at profit margin. But still, gross margins is still at a nice double digit. 45% gross margin rates are actually pretty impressive to see, to say the least. Next, let's take a look at profit margins. Profit margins in 2017 was 27.6%, in 2018 was 25.6%, and in 2019 was 23.2%. Again, you're starting to see a little bit of a decrease here, and things like this doesn't necessarily mean it's a bad thing. It's just depending on where this company has put most of its money. Is it trying to build up new businesses? Are these new businesses taking a little bit of a chunk? Because usually when you start a new business or start new product lines or just some new type of movement in a company, at the beginning you start usually to see either no returns or low returns. So again, this is not bad to see. Obviously, you would want to see the complete opposite, where you want to see profit margins and gross profit margins increase, but that's not the case. But still, a 23.2% of profit margins, this company is returning back money. It's making money at the end of the day. So now let's take a look at JD. JD's gross margins, like I mentioned, would have been expected to be a lot lower. So let's take a look at just the most recent 3 years. In 2017, it was 14%. In 2018, it was 14.3%, and in 2019 it was 14.6%. So one thing is different here compared to Alibaba, which I do like. The first thing I do like is the gross margin here compared to Alibaba is actually growing, where in Alibaba the gross margins were decreasing. So that's a good thing. The only thing though, it is growing at a very small rate, from 14% to 14.3 to 14.6. Next, let's take a look at this company's profit margins. So profit margins for JD in 2017 were about 0%. It made no money in 2017. In 2018, gross profit margins were negative 0.5%. So again, pretty much flat even. A negative 0.5% is pretty much losing nothing. So again, another flat day. And on 2019, it was actually 2.1%, which was the first quarter where it seems in the past 3 years, first year in the past 3 years where JD actually made money. So that's actually a good thing, but I don't think there is any real consistency. One thing, if we pull back, we can see right that JD's margins were from very low negative, started to increasing to eventually breaking flat even, and are now a little bit positive. And same with their gross margins, right, has also increased, by steps throughout the few past years. But to me though, that profit margins is still so low that I don't know. This one's a little difficult. I think this one's gonna be weird. I'm actually gonna give 1 point to both BABA and JD to here, because BABA does have the better margins, but we are seeing the decrease there, but it's still providing a positive positive profit margins to investors. JD, on the other hand, is actually seeing an increase in gross profit margins, and is seeing in gross margins and in profit margins. Even though it's barely making money, it does seem to show an improvement. So for those reasons, I'm gonna give a point to both of them. All right, so next we're gonna take a look at revenue breakdown. So revenue breakdown is pretty much what it seems. We're gonna see where we're gonna take a look at the most recent quarter and see where that company's revenue is coming from and how much percentage of that revenue comes from that segment. So let's start off with Alibaba. So Alibaba here, I'm in their most recent earnings report, and they actually have a lot of information here. And if you guys have watched my previous Alibaba episode, most of this might already be known to you. But right now, like I said, out of Alibaba's 100%, 82% of the total revenue comes from commerce business, from some form of commerce business, some form of stores and stuff. But remember, most of this is business to business transaction. All right, that's actually pretty big, 82%. But they are in so many different segments, right? They have like they have so many different types of small businesses within here. They have customer management, commissions, China commerce wholesales, international commerce retail, international wholesale, logistics servers, local consumer services, and they have others. So all that makes up 82%, and that's actually a big portion. And we can see total core commerce compared to same time last year grew 9%. So that grew 19% compared to same time last year. Next, this company is in other types of products. It is 11% of this company's total revenue comes from cloud and computing. And that's actually pretty cool to see, right? Cloud computing is something I am very bullish in. And that's saw 58% growth compared to same time last year. 5% comes from digital media entertainment, which only saw a 5% increase. And then 2% of this company's total revenue comes from others. So we can see this company is very diversified, and it has products in different items, right? It has this breakdown in different items, and we're seeing growth in most of those segments. All right, so next let's take a look at JD, and JD's revenue pretty much comes from only 2 services. The 2 services that it comes from is product revenues, which is, like I said, this is pretty much more like a store, and it has general merchandise revenues, and then it has electrical and home appliances revenue. And we can see, as compared to the same time last year, general merchandise revenues grew about 38%. Electronics and home appliances revenue grew about 10% compared to the same time last year in its most recent quarter. The other small portion of this company's revenue, and that actually makes up close to, let's just do the quick math here. It's gonna be 510 divided by 576. So about 89% of this company's total revenue pretty much comes from its commerce business. The other 12% comes from marketplace and advertising services and logistics and other services. And this is what they call their net services revenue. And this is up, their market and advertisement services are up 17% compared to the same time last year. and their logistics and other services are up 54% compared to same time last year. So we do see, right, double digits in almost every type of their segments, and both are pretty good. So at the end of the day, both of them do have a revenue breakdown that are seeing an increase in growth. To me, I do like Alibaba's, this is just my personal opinion. I do like Alibaba's revenue breakdown better just because it has clouding and it has media, it has just different segments. But again, let's take a look at revenue breakdown. I think I'm gonna have to give 1 point to both, again, because we both saw in the revenue breakdown how they have different types of products, but they both saw a growth in both of those products. The next one I'm gonna take a look at is overall business, and overall business is just my opinion on the overall company. So pretty much on what we saw right now, and right now for overall business, I like Alibaba better just because it has a huge portion, 11% of this company's revenue comes from clouding, and I am very bullish in the clouding market. So for that, I am gonna give a business into Alibaba, and just because the overall breakdown is more than just products, they have so many different sectors that they're providing, right? We took a look at this company's most recent earnings, look at all those different services that this company provides, and it has broken it down where JD only has a smaller section compared to that. But a few things to know is JD is trying to improve their overall breakdown. They just did JD Health, which is an Android application that is pretty much helping in providing pharmaceutical and healthcare products and services, including online sales of medicines and medical supplies. And this is something they released early in January, and it's doing pretty well for this recent quarter. But again, not much of an impact, but I think it's pretty smart that they are trying to diversify a bit more. The second thing that's also good for JD is they just recently announced that it's expanding its clouding and AI presence. So this is something that I like Baba over JD a little bit more. And just since JD is pretty much still not much revenue comes from here, it is still good to see that they are trying to grow their presence here. But still, I don't think I'm gonna change my mind after reading those sections. So at overall business, I still have to give it to Baba. At the end of the day, I'm really seeing that Baba might end up being the winner. We still have a lot of points to tally up, but right now Baba does have a nice head start on JD. All right, so next we're gonna take a look at this company's overall balance sheet. So when we're taking a look at balance sheets, again, we are here in Lazy FA. All right, so next we're here at the balance sheet, and the balance sheet, I just pretty much want to see how this company's most recent years have been doing, and how much cash and cash equivalents does this company have to pretty much pay off its long-term debt. So first thing, we're here with Baba, and let's start off with liabilities. This company's liability has somewhere around $112 billion of non-current debt, $22 billion of current debt, which ends up equaling somewhere around $135 billion of debt in general. So let's just take a look at this company's cash. So cash and cash equivalents is about 28 billion, but this company does have non-current investments, and non-current investments are usually just places where they put their cash. They might put it in like a long-term CD where it collects a little bit more interest, or they might put it in some other form of savings account where they can collect a little more interest, but it takes some time for them to collect that money. Then it has about $13 billion in current investments. So at the end of the day, if this company was to grab off all its cashable investments, I would add the current investments, 13 billion, plus non-current investments of 241. So that's about 260, 255, plus a 30 billion cash in cash. So close to $280 billion in some form of cash, non-current investments or current investments. And the main reason I added the non-current investments because eventually this can actually end up a current investment, and there'll be cash that this company can grab. So that pretty much pay off this company's total non-current debt and current debt, which I think is pretty impressive. So this company definitely has a nice balance sheet. Next, another thing I want to mention is a huge portion of BABA's liability distribution is deferred revenue. And deferred revenue, if you guys don't know, it's just revenue that this company has collected, but it has yet to provide the service to its customer. So eventually, once it provides that service to its customer, it ends up going into a form of revenue and into the income statement and cash flow statement. So I do think this is what I consider a fake revenue. So I do like BABA's balance sheet. Next, let's take a look at JD's. JD's balance sheet is pretty good too. Let's take a look at non-current debt and current debt. So non-current debt is about 15 billion, and I keep saying dollars, guys, but remember, this is a foreign company, so this might actually be in renminbis. I forget the Chinese currency. So right now it might just indicate dollars, but the currency is not United States dollar, is actually the Chinese currency. So non-current debt, this company has about 15 billion, and current debt has about 3 billion, so close to 18 and 19 billion. This company's current investments is only 26 billion. So this company has just enough current quick cash to pretty much pay off its total debt. And that to me is actually pretty impressive. Next, let's take a look at cash and cash equivalents and non-current investments. So again, this company has current investments of 26 billion, non-current investments of 57 billion, and cash equivalents of about 5.7. So that's a little bit close to, what would I say? That's 30, 60, close to 90 billion. So again, this company also has a great balance sheet in my opinion. So for both these companies, I'm gonna have to give a point here. So for balance sheet, we're giving a point both to BABA and JD. And these were actually the longest, so pretty much the rest few points are actually going to be pretty quick to go through. So I hope you guys are enjoying this video. And like always, guys, if you guys are enjoying, make sure to hit that subscribe button. Make sure to let me know which one you guys want me to take a look at next, Alibaba versus Amazon or JD versus Amazon, on the comments below. All right, so next what's the next thing we're taking a look at? Operating cash flow versus revenue, and operating cash flow versus earnings per share. So what is operating cash flow? Operating cash flow is the cash flow this company makes from its everyday activities. And this to me is the most important cash flow to take a look at, because your overall business should be making you money. If not, then what's the freaking point of having this damn business? So operating cash flow is here in the orange, and we're seeing it is at an uptrend. But right now what I'm comparing it is to revenue. So if your revenue is increasing, you would expect your operating cash flow to also be increasing. And that's the first thing we want to see. And here in Alibaba, we are seeing that. We're seeing an increase in revenue, and we're also seeing an increase on net cash flow from operations. And the amount of margins that it comes from its revenue is actually pretty impressive. 40% of this company's revenue is actually moved to its net cash flow from operations. So that's actually pretty impressive. Next, let's take a look at JD. And JD, I'm not liking this, right? JD's revenue is increasing, but the net cash flow from operations isn't really moving at all, right? It's trying to pick up, but it's not. So and the margins are usually pretty low, but again, this is very similar to why I mentioned that margins that we talked about earlier, that is expected to show, right? The margin levels for JD are going to be lower. But at least here, I would have loved to see a similar lifestyle where revenue is going up, net cash flow from operations is going up. So for this one, I'm actually gonna have to give a point to BABA on operating cash flow versus revenue. Next, we're gonna take a look at operating cash flow versus earnings per share. And this is similar things where we should see similar patterns, right? As operating cash flow is increasing, you should see earnings per share also increasing. And for Alibaba, even though there are some crazy ups and downs, if you take a look at the overall trend, it is kind of matching. So that's pretty impressive to see that this company, as obviously, and it's what you expected to see, as it makes more revenue, it makes more money from cash flow from operations, and it ends up making more earnings per share. So that's looking good. For JD, it's actually okay too. For JD, we're seeing an increase of cash flow, not by much, but we're also seeing it's actually, if you take a look at it, it's actually following the similar path, like the similar wave style as net cash flow from operations. But at the end of the day, Baba is the big winner here. So I'm gonna have to give that point to Alibaba on operating cash flow versus earnings per share. Woo! And this is definitely a pretty cool episode. I actually learned a lot from here, guys. So I'm hoping you guys are enjoying it. Next, we're going to take a look at valuations for this company. And here I'm going to be taking a look at Seeking Alpha. So here I'm taking a look at forward price to earnings ratio because I believe the market is more of a future type of valuation type thing based on what the company is doing now, right? I don't really care what the company is doing now. I want to know what the heck this company is going to do in the future. So let's take a look at Baba's forward PE ratio. In 2020, this company is expected to make $10.84, which gives this company a forward PE ratio, and let me zoom in for you guys, gives this company a forward PE ratio of 18.43. JD, on the other hand, in 2021 is expected to make $1.91, which has a forward PE ratio of 26.1. So obviously, if we're just taking a look at forward PE ratio, Alibaba seems like a better value. And for that reasons, I'm gonna have to give a point to Baba. Next, let's take a look at forward price to sales ratio. Forward price to sales ratio, it's very hard to use these two to determine both these companies, right? Because usually for retail businesses, business to consumer, their forward price to sales ratio are a lot lower, opposed to a company that's actually dealing with other customers and dealing with higher margins. You will expect a higher forward price to sales ratio. So for Alibaba's forward price to sales ratio is 4.6, compared to JD's 0.62. So if we just were to take a look at price to sales ratio for this company, it does seem like Alibaba, that JD is a lot cheaper at the moment because it has a lower forward price to sales ratio. But again, we did see that the margins for these companies are in whole different levels, right? Gross margins for Baba were 45%. Gross margins for JD were 14.6%. So in theory, this company's margins are should be about 3 times higher. So just based out of that, if we let's just do 0.62 and assume that JD is making the same margins as Alibaba. So let's times this by 3, right? Because JD right now has about a 15 gross margins. Alibaba has about a 45, which is 3 times bigger. This gives the company if we kind of compare them, a forward price to sales ratio of 1.86. This is still a lot cheaper than Baba. So I would have to give the price to sales ratio, forward price to sales ratio to JD. And again, right, we can see the actual winner here, and just my thoughts, right? My thoughts, this is just my opinion. At the end of the day, like Baba better, right? We saw they have better margins, they have better revenue breakdown. Their overall business is in some things I'm more bullish on. Their operating cash flow and the amount of money they're providing with that operating cash flow is better. And just the forward PE ratio forward price to sales ratio are not bad for this company. Even though the forward price to sales ratio for JD is better, at the end of the day, my business that I would go with would be Baba, right? And here, it doesn't mean that JD, like I mentioned, it does not mean that JD at all is a bad investment. I am not a professional, so both of these can actually be the bad investments, and I just wouldn't know. The only thing is, I would, if I was to pick one of these two companies, I would choose Baba over JD. That's the only thing I'm saying. I don't have a position in any of these, and at the moment, I don't think I will open up a position in any. And it's not because they're bad investments, right? To me, I just feel like I can find better investments elsewhere, and hopefully by doing these videos, I might end up finding a company that I would like to invest in. So like always, guys, I hope you guys enjoyed today's episode. Don't forget to hit that subscribe button. Check me out on YouTube, on my Twitter, and on my Discord. All of them are in the information. And if you're listening to the podcast, I would truly appreciate it if you just left me a great review. I am humbled by all the support that I'm getting from you guys. And let me know in the comments, which one do you guys want me to take a look at next? Alibaba versus Amazon or JD versus Amazon? Post on the comments and let me know. Take care, guys. And also in my Discord group, if you want to take a look at my portfolio, I have a few portfolios adding up to close to $40,000. If you guys want to take a look at them, they are on my Discord. I have them open for the public if you guys want to come look at, right? So take care, guys. Have a good night and see you next time.